following is a presentation of TFNN. The Global Market Pulse with your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Hi, guys. Welcome back to the show. I think we've got a Fed announcement today. We've got an FOMC minutes. We've got Yellen talking. Normal course of action, if you guys have been living in a cave, this lady is not going to jar the marketplace. She's not going to pull a Greenspan and tell people they're irrationally exuberant. And that being said, I just, even with the rate hike looming, and I think it was over 90% of CNBC poll that they did, expecting actually over 50 basis points by the end of the year. She's going to temper that by some kind of stay the course, 1,000 points of light. We're at the wheel. We're watching it like a hawk. Did I say hawk? Watching it like a dove. And as these things unfold and as she speaks, I think the markets, the currencies, the dollar, the S&Ps, the notes, this is a pretty serious precipice. Excuse me, folks. Rate hike pretty much imminently locked in my opinion. I mean, there's some economic figures that are continuing to kind of compress up into a rooftop here, and at some point, they've got to kind of call a spade here. So, she's going to try to temper the lingo, if you will, but we may have some really decent volatility as she's speaking and as some of these comments come out. And of course, she's going to try to make the U.S. stock market go up no matter what. So the theme of today's show is we're going to look at some instruments that actually haven't acted like we had talked about them possibly acting. Namely, one of them, crude oil. We're going to pull up crude oil, one of our automated systems. In fact, we had a caller yesterday that we had talked about staying in a range. If you back up on crude oil, and we got to talk about soybeans today too, because they did some things, or soybeans did some things that we weren't really expecting. 60-50, we talked about leveraging off that, and we talked about this staying within our daily profiles, or at least staying within our weekly profiles. If you step back, we're obviously still within our weekly profiles, but we've kind of edged a little bit higher here, and one of our automated systems got clipped based on the daily profiles and for highs. So we got clipped about 61.20, 61.21, somewhere in there. And we had entered that trade a little bit lower based on trying to, explore the entire fair auction down into 57.40. So again, these are the theme of some of the things we're going to talk about today are what do you do when trades don't go your way that you put on you? By all means, if you're trading underlying instruments, you need to have a stop in place always, because it's a part of the game, and you're trying to do a risk reward scenario. You're trying to risk 1 or 2 points to try to make 3 or 4, 6 or 8 points, and that particular math over time will work out in your favor, just like the bean trade we're going to look at. And I got to say kudos to John up in Philadelphia, because he had thrown some fundamental things out there that I think the market may have started latching onto. So, there's always, there's buyers and sellers, there's bulls and bears. We want to talk a little bit today about, placing stops and, what do you do as these things actually don't go your way. So crude oil, this is not a big move. I mean, this is almost possibly noise here, and I'm actually very prepared to try this again around that 62.20 cent change. Let's go up into 62.28. I'd be willing to easily try that again from the short side up there. But the way we look at it is kind of once you start crossing the borders, and especially if you get a daily close, you can't really place stops on daily closes. You have to kind of, in my opinion, place them around price action. So we get stuffed out. We try the 62.27 again, and we also try the 60 below 60.50 again. Possibility on crude oil. Now that would coincide with some of the other indicators that we're looking at. I'm still a big fan of crude oil kind of bouncing around. There's some bullish comments out there. There's some supply talk now on crude oil, but again, I think we're just going to more than likely bounce around here. Let's take a look immediately at soybeans. Now this is an unbelievably awesome example of keeping stops in. Now, here's a November. This is, new crop beans, as they say. We talked about, trying to get back in New Orleans on the short side, just to give a little bit of a history lesson here. And as we had come down into the $9 range, that was somewhat of a target-rich environment. We talked about wanting to get a close below $9 a bushel. That didn't happen. And then, we would take a stab at 9.13 again, but place your stops. And this is what happens if you don't place your stops. Beans could be against you 20, 30 cents. And depending on the appetite for risk you have, that's something I personally want to avoid is being on the wrong side that deep. I think we've got a caller on the line today. It's from Pompano Beach, Florida. Are you there? Okay. Thought you said we had a caller. No problem. Okay. He can always. Okay. Well, if he wants to call back, that's fine. We'll talk to him. I'm sorry if I didn't get to him quick enough there. I was on a paragraph about taking stops here. Here we go. Here's the weekly view on this bean trade. Now, again, we always use these inflection points on the dailies and weeklies mainly to kind of run this show and let the 240 profiles kind of regulate the trade one way or the other. And I wanted to show you the weekly view on soybeans because just like on crude oil, it's a very, very similar situation. Just like on crude oil, you have the 60-50 leverage point based on the top of our box. And if you haven't been watching this show and you're kind of joining us midstream here, those are our versions of automatically outputting type market profile environment. So that means that the red line is the top of what we call the balanced area. The green line is what we call the bottom inflection point of the balanced area, or the fair auction, right? That's where we feel prices are fairly, balanced. So when we get outside these areas, the theory is, in a very general sense, there's many innuendos, there's very deep dissertations you can get in on market profile theory and how to also combine some other bias typed indicators around these profiles. You've got some POCs that we normally don't talk about unless we have a relatively wide profile. This is almost like the hill, or it's the peak of distribution in statistics 101, but we call them the point of control. So that's kind of the balance point of the profile, the balance point of the top of the hill, the apex, and kind of look at that as, that peak of distribution. It's not exactly like that. It's almost like the mode. If you've got an average and you've got a mode, I mean, this is more than likely classified best as the mode. So John had actually asked me to pull up the weekly on beans, and just like crude oil, that 62.27 up top on our weekly view, you've got a very similar situation here with the weekly unfair lows at 940. So again, this is something we've reached a high of 938.5. John, I mean, I'm actually willing to take a stab on the short side again on the weekly unfair lows. So I think we've got our caller back, Kay Rico from Pompano Beach.
Yes, sir. Hi.
Good. How are you?
Okay. I'm sorry I lost you before. So
No problem.
I was wondering, today's the FOMC big deal afternoon Wednesday, 2 o'clock. How do you think the ES minis, the market's going to trade before that? And not to put you on the spot, how do you think it's going to react after the 2 o'clock announcement?
Right. Okay. So, here's the S&Ps. We've been talking about our breadth situation on our scanner. I'm not going to pull that up right now. Let me just shut that down here. I'm not going to pull that up right now because it's basically been the same tune. It's, we've had our dailies relatively negative, flip-flopping around. Our weeklies crossed negative for the first time since October 24th on June 5th. And that's a very, very strong signal. But when you've got an FOMC meeting coming out and you've had a rally snapback situation like we had yesterday, now our automated systems looked at this 60-66 area as a target-rich environment as they had, kind of shorted some up here around the 2102 area, and went that route because the filter was biased towards the short side, and we weren't looking to buy breakouts or buy support. We were looking to sell rallies and sell breakdowns. We talked about hopefully getting a daily close below this 62-66 area after we had reached there, and that was kind of a little bit of a release valve for the shorts. And we talked about not taking long positions on support, not being one of these buy the dippers. All right, now that didn't work out. That wasn't the best monetary situation to not do as of yesterday, but from a risk reward standpoint and from a high probability trading standpoint, I think that was actually the right thing to do, was to not buy the dip. I mean, you didn't have the odds in your favor, and you also, from a short standpoint, this is our 240 environment. You had this kind of above 280, all bets are off for a while because that's the regulation of the trade down, the 240s. All these things I'm talking about are points in time and space, however you want to call them. They're inflection points to be aware of that just help me try to navigate the minefield. Now, what do I think is going to happen before the announcement? I mean, stepping back for a minute, I mean, you're in the middle of a fair auction on the weekly. You're pretty much in the middle of a fair auction on the daily, even though your breadth is still somewhat negative on the weekly and the daily, believe it or not. I think announcements, you got to kind of sit on the sidelines, and we talk about trading the reaction instead of the initial action.
Right.
Do I think the market's going to kind of continue to drift north before she talks? I mean, put a gun to my head. I actually think the market's more than likely going to come down. I think whatever she says, she's got to talk about September. That's some imminently, let's go to break and we'll continue this if you can hang around.
Yes, sir.
Okay, great.
Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com. TFNN.com. Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, guys. Welcome back to the show. Do we have our friend from Pompano Beach here?
Yes, I am.
Great. That's Pompano Beach that's right near, what is that? Well, that's on that
Fort
strip
Lauderdale.
down between Lauderdale and near Lauderdale,
Yeah.
right?
Yeah, I'm just on the cusp, on the edge by the ocean.
Okay, cool. Nice area. Considering where the S&Ps are, I want to back up just a little bit. I mean, this may be one of those environments. Finally, we had kind of notes. I mean, we're in a big transition phase possibly right now, and in the last 5 or 6 years, I mean, the portfolio managers got that double-edged sword benefit of being long treasuries as a hedge against long market. Most of them don't even understand the currency situation, so they're that's the three components of trying to balance a portfolio or balance an equation, if you will, generally speaking. So long treasuries, long stock, and looking at the currency hedge with the dollar or whatever denomination that you got most of your stocks piled into as a manager. I think what could possibly happen now is we may have the double it, and they got the benefit of the rising notes and bonds and the rising market. I think we may have finally a reciprocal of that situation, which is possibly notes and bonds falling and stock market falling at the same time, that would be pretty detrimental to most of the people out there who think they're whiz-bang registered investment advisors that have gotten the free lift that they've had the past couple of years, and they're going to have to finally scratch their heads and say, wow, I'm just going to have to start picking stocks better, and I'm going to have to actually work for a living this time. That being said, I'm looking at the notes talking about today's action. This is the 10-year I'm showing right now. We talked about, I'm not so sure that this is over. I'm not so sure what Yellen's going to say. I'm not so sure if they actually ever are going to raise rates, but it's starting to look kind of good that at least they're going to do some token situation, even though the rest of the world is backing up. I don't know, exactly if that's going to be the total answer to this situation, but the notes could start creeping back down while she's talking below 125.24. The market may not like that, being the stock market, and going back to the S&Ps. And I'm kind of throwing a lot of things in here while we're talking. I understand that.
That's okay.
But the S&Ps, I just looking at the breadth again, I rely on that heavily. I mean, it's percentage wise. We've done our back testing. It can keep you in some kind of sanity situation on what side of the market to block out. Now, I'm blocking out the long side right now. All right, because of that breadth is telling me there's some disconnect still here. Even with that bounce yesterday, just like we've had bounces before, it really doesn't seem to shake the fleas off of the situation at hand, which is there's not the cohesiveness in the underlying instruments right now of getting at least past balance areas on a whole into that unbalanced area up top, which means that we then can kind of breathe higher. So, I'm looking at 2102 as a selling point on the S&Ps.
Now, are you using the E-mini ESU5 or the ESM5?
I'm using the ESU5 right now.
Okay, I had to get that clear because I've seen some guys using the ESM5 still.
Yeah, I think there's probably the liquidity is just getting sucked out of that thing every minute that we talk on the June contract. I know that it's a generally good thing to do is start rolling when everybody else does. You can get stuck you guys traded futures long enough, you know exactly what I'm talking about. Your broker's calling you ready to kill you. Because you're in an illiquid crude contract or corn contract or whatever that he's going to have to make an appointment to get you out of. So it's always good if you're trading futures to kind of pay attention to the so-called roll dates, and just kind of go with the flow. And if you've got some long positions or short positions on the current contract, they can either roll them for you or you can electronically do it. Now, a lot of folks, especially on spreads, try to wiggle out of spreads, leg in and leg out of spreads. I mean, it's always been, you're 50% right and wrong on those things usually. Just get in and get out of a spread, get in and get out of a roll. Listen, thanks for calling today from Pompano Beach. I think we're going to go to break again. And I hope, okay, cool. We'll be right back, guys.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Larry Pesavento has just announced a new service that is designed specifically for technical traders that follow Fibonacci patterns in many markets and are always on the lookout for profitable trade setups. Larry will be sending his subscribers a constant stream of charts and videos whenever he finds formations and trade setups in the market you need to know about. And each Monday morning, you'll receive Larry's written report that provides detailed commentary on the charts and videos that he sent out, as well as what to expect for the week of trading ahead. Larry's first issue will be delivered this coming Monday, and in the days remaining, we're offering a special launch promotion where you can get a full month of Larry's new service, Fibonacci 24/7, for only $47 with a 30-day money-back guarantee. Larry has already started sending out charts and videos to his subscribers that have signed up, so don't delay and sign up now. You can sign up for Larry Pesavento's Fibonacci 24/7 right now by visiting the front page of TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi guys, welcome back to the show. We're going to take a look at gold really quick, just kind of go through some of the things we normally talk about here just to cover those bases. I've been a big fan of kind of, not getting too involved with gold lately. It's just, not reacting really on any level to any type of global impacting events, seemingly so. Still, here's the weekly situation on the August contract, kind of low profiles, and we could get back up there in a heartbeat. But I just don't, see that this is something probability-wise we can completely get both feet involved with again. That's the situation on August gold. Let's take a look at the XLE. This is something, here's the daily situation. I mean, crude oil's been kind of hanging around up there. Just like before, we had a great relative strength trade in this particular ETF relative to gold. It's almost been the opposite situation here. Well, not almost. It has been the opposite situation on the way down. It's been the great relative strength short situation. So, again, not cooperating with the price of crude oil, kind of continuing to kind of gradually go up. I think these are, kind of lost not lost, but these are situations that I think now with crude oil maybe possibly, in my opinion, still staying in that weekly range. You're just going to have the ETF itself just continue to mirror that same image, maybe trailing down and showing that relative weakness. I mean, is it going to turn around at some point? Possibly, but you've got to pay attention to the leverage points here. 77 on the bottom. Again, if crude oil starts coming back off of that unfair high on the weekly and daily, you could see this thing actually head lower. Don't think that the XLE is on sale here. You got to kind of break stride a little bit, get back above profiles. Remember what happened back here in March. I mean, we had to get that significant break above just right here, get above the fair auction, then it's okay to get back in the water. Remember that, retest, and boom, and then we ended up making 7-8 points here. I think we've got a caller, John, Philadelphia.
Hey, Mr.
Hey.
Logan. John Logan, how are you?
Good to hear from you.
Excellent. Listen, it is terrific technology and terrific service on your part to do these shows. I love the fact that you're doing it from the Philippines as you're wrapping your day up, and we're here at the start of New York City. It's just fabulous. Both you and Tom O'Brien crew.
Thank you.
Say, John, you just went over gold and shared your opinion. Thank you. Can I just ask you? You mentioned the gold on the weekly, and the bottom of the TAS box is, I believe, something like 1187 or so, and we're now into the third week where price is under the bottom of the box. Right. Is it fair to say, from your perspective, there's no reason to be trying the long side so long as we remain under the bottom of that box?
Yeah, I think that's a great statement, and I'm glad you brought it up. I've been just kind of depressed a little bit because gold is just not moving, and it's just not worth trading right now. And that, I think that really was predicated upon something I didn't say, which I'm glad you brought this up, was let's get a weekly close back up into above 1187 and at least get back into a balanced area for gold before anyone even thinks about going long gold. I mean, obviously you could go long here at 1178 and maybe it goes up to 1241 and you look like a brain surgeon if you bought it cheaper than waiting for it to get back above the yeah, but gold could go to 1150 really quick here, and I think that's the biggest question I get from people sometimes, John. And again, I'm glad you brought this up. Is why would you wait until it goes higher to buy it? Again, just like the XLE we just looked at a while ago. I mean, you want, in my opinion, it's been very beneficial for our proprietary traders here and other places I've been involved with to get some conviction about actually feeling that we've gotten through some of the congestion or some of the resistance areas in this case to really start getting back into the long camp. And on gold in particular, to answer your question, I would feel much better if this thing closed on a weekly above 1187 and then we're able to use that as a stop based on your appetite for risk below that to kind of look at that as a, I got to say, uncle again on gold. I mean, gold's been nerve-wracking to trade. I mean, lately, I don't know if you feel the same way. It's just, kind of been chopping around here for months. It's been crazy,
No, I absolutely concur, and thanks for answering that question, John. I wanted to follow that up and ask if you could pull up the ETF SPY. That's the ETF for the S&P 500, and the reason I ask you for that, now you've shared with us, and I thank you for that, the data on the ESU 5s, the S&P September futures. You've gone through that very thorough discussion of the U.S. stock market as you see it because of the breadth performance that your systems are identifying. I asked you about SPY for this reason. Every time on the futures when we come to a transition from one contract to the next, June to September in this case, or March to June, 3 months ago. Every time that happens, John, I notice that the new boxes that has profile ranges, the high, the low, the point of control, I notice those rarely line up. And and once you get 3-4 weeks into the new contract, that lack of lineup seems to become irrelevant. But now that we're in this transition phase from June futures to SEP, can you tell us the SPY TAS data? Does this tell you anything different compared to the futures?
Yeah, it's a great question. To answer the first part of your first paragraph there, again, I think maybe even you and I have talked about this personally before, maybe a year ago, but I'll just, it's a great thing to go back over. We have our data on quite a few different platforms, and we've got our own platform. I don't even show you guys. We have our own charting package, and we have an execution piece that we've pretty much got bolted into CQG's API for trading futures. It's all in beta. But that being said, with almost 10 platforms we deal with, one of them being Bloomberg, it's amazing that every single ticker plant we deal with, being the data ticker plant that most of these platforms use, they compile the data a little bit differently. Their closes are a little bit differently. So when we go to a continuous contract to try to display across the board, across all platforms, continuous contracts are actually treated differently on different platforms. So we just went to the raw contract on the futures side to kind of have the profiles follow, just because it was the best way to make consistent as much as possible when I do a talk or a speech or whatever we do. And people have different platforms. They will generally be somewhat the same because we're all looking at the same contract and not a amalgamation of meshing November beans into July beans or whatever. So, and that changes the data historically a little bit, which is what some of the profiles are built on.
Yes.
Because so that being said, sorry to drag that out so far. That being said, I mean, generally speaking, like when we changed from the June contract on the S&Ps to the September, we were generally in the same neighborhood. I mean, it wasn't to the tick, the levels, so to speak, but we were in the general neighborhood. I mean, I think we're on 68 on the June contract on the daily and for highs, and I think we're like 62 on September, something like that. I mean, you've got a little bit, you've got the carrying fees on the more so on the September contract, as you know, and that's why the futures prices are different. And a lot of people, if they look into those equations of how they calculate carrying charges and all that, it's a really interesting read, and I think people could get some benefit about that, about how futures prices actually are priced like that and why. But let's go to the SPY. The second part of your question is, I think we're in the general neighborhood when we roll contracts like the S&Ps in the 10 years, but it's really not ever to the tick the same, and we just went with the raw contract. Take a look at the SPYs. I've got it up on our screen right now. You'll notice gaps in the data. I mean, gaps in the closes from the day and the opening of the next day, and it's been significant this past week. I mean, this is kind of wild looking. I mean, we've had some decent gaps on the opening here. The SPY obviously is an ETF that trades only during U.S. trading hours. And please jump in anytime, John, when I'm speaking. I'm just trying to answer your questions.
No. Please do.
Okay. So when previously, like when I was in Chicago, in fact, I mean, you didn't have things that happened in Asia, Turkey, South Africa, wherever, Europe, that generally impacted U.S. futures prices that much overnight. I mean, you had really light trading. You had kind of suckers games at night on trading the U.S. futures, 3 in the morning, whatever. and that data was, for the most part in my mind, able to be excluded when you start thinking about using volume at price and
Right.
to include that volume in an equation that you're going to actually use the next day. It was almost something you wanted to omit. So when you look at the spiders back then, you got a really, in my opinion, great picture because you threw that stuff out that wasn't really trading during U.S. market, or that wasn't trading during U.S. market hours. So when you look at this now, and you try to do profiles based on excluding that data now, that I actually feel is very important, you've got some profiles that may not, be the best way to calculate the U.S. S&P 500 stock market. And if you can catch my drift a little bit, if we left out data on the November beans and just excluded it altogether, and then tried to form a picture based on pieces of that data sample set, I don't think you'd feel real good about being able to trade on information that was incomplete. And that's kind of how I feel a little bit about the spiders and the diamonds and the QQQs now, because you're excluding data to build profiles. Now, I think people that pay attention to the futures and trade the spiders, that's a whole different ballgame, because let's just look at it. You've got 208.19 down here. The price action is relatively the same as the futures. I'm going to pull that up and let everybody see that. And I'm going to let everybody see where the inflection points on the daily were relative and are relative to the futures. So 208.19, you've got 2066.22 down here. And if you'll notice, this profile looks very similar to that spider profile. And this level down here is very similar to that spider level on a relative scale, if you know what I mean.
John, thanks so much for that explanation. I will just share an observation with you.
Sure.
I personally find it a great value in seeing the output of your work, which, by the way, is fabulous. Comparing both the futures and the spiders. Let me just give your listeners an example as I'm looking at your daily chart from the market profile, which was basically constant from late March into the 1st of June. And John, it's just stupendous that, for example, there was an S&P sell-off back into April 30th. And then there was an S&P sell-off into just last week, June 9th. And the bottom of the daily price was exactly at the bottom of the TAS market profile that's been constant for some period of time. I find that incredibly valuable input to saying, you know what, if you're short, take your profits against those lows. And if we bust through to the downside, that's a signal. But until you do so, your market profile info is saying, hey, watch out, don't get too bearish too quick.
Yeah, I'm glad you said that. I feel the same way. Unfortunately, I was not in the camp of buying the dips, so those were just target environments, probably like you. And I was not terrified, but I was just like, the probabilities aren't on our side. I don't want to try to buy this inflection point. I'm just using it to take some shorts off. And I hear you.
John, thanks so much for your time. Enjoyed this conversation. Your explanations is just terrific.
Thanks, John. Thanks for calling in. We'll be right back, guys.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Hi, guys. Welcome back to the show. And thanks so much for our friend in Pompano Beach calling in earlier. And obviously, without question, John from Philadelphia, just awesome conversation every time with that caller that calls in, and he's in the den, and he's just providing great information on a daily basis. I hope you guys are getting something out of a lot of the comments that he puts in there. We got about 3.5 minutes left, and I'm just going to review probably the points of contention here today. These are the movers and the shakers of the immediate reactionary type things that are going to happen when it comes to some of the things that might be said by Yellen today. Like Eddie said, I mean, it's kind of scary that Eddie was talking earlier this week about the euro and how it is not really coming off and just hanging around above these daily profiles. I'm a big fan of trying to short this below 120, 112.25. But I'll be honest with you, the longer it hangs out up here, the scarier it looks for the shorts. And again, just like John and I talked earlier, it's good to let things confirm a lot of times that they're going in the right direction, and shorten it now instead of shortening when it gets back here in the balanced area and possibly heading even lower would be probably the smart thing to do. And remember, you're going to have some mega volatility. And listen, if you don't think that there's some games being played out there on some of these announcements, I mean, the guy who ran TT Trader owned it and everything. I mean, like initially, I was in Chicago. I mean, they know where stops are. I mean, these are widely known, facts on servers. People have their orders placed. They're not locally held. If you place a stop on your machine, no platform in the world now will let you do that because your machine might go down. You place the stop, and it's not on the server up in La La Land up there. And there are information links that let people know where people are placing stops. So let's say you're trying to trade before the announcement. There's a horde of stops on the euro. Let's call it at 114. Well, that information, somebody knows it, and somebody with a lot of money will run that stop just to get short more up there. I'm kind of going off on a tangent here, but it's always, in my opinion, good to let these things come out, because a lot of these wild gyration knee-jerk reactions are not people digesting the information wrong at the beginning. It stops being run. So, keep that in mind. We're going to have some volatility today. The euro, I'm still a big fan of this thing dropping below 112.25. I may be wrong, but again, that's why we wait for confirmations, and by all means, put stops in. I want to go to the Japanese yen really quick. This is one that's just been on the books for a while. Been a big fan of this, buying support. Got stopped out a little bit below 123.29 the other day, but we're back in business. I think we could easily start seeing this thing on a long-term basis lurch up into the 126, 127 area. Going into the U.S. dollar situation, here we go. Not looking good here. This is our daily situation, but remember, weekly takes precedence over daily over down the line. We want to see this thing get back above 95.30, and then I'm going to feel a little bit better about get back in the water on the long side on the U.S. dollar. I mean, considering that she may mention that, this is, foregone conclusion, blah, 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 the dollar could rise, but you'd like this, again, to see the confirmation cross the hurdle, get back above the threshold of a major inflection point on our longest term view that we look at, 95.30 on the U.S. dollar. Thanks again to the callers today. Great conversation. I hope everybody got something out of that. And we'll be back again tomorrow, guys.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.